Robert Gmeiner is an assistant professor of financial economics at Methodist University. His research focuses on economic analysis of government policy with an emphasis on monetary policy and international trade. And recently, he has been branching out into other topics. Robert, thank you so much for taking the time to talk to me today.
I'm glad to be here.
So, to start, I'd love to ask you about monetary policy in this moment that we're in right now. I've been asking a framing question, how much money should exist, and just wondering if that's a good way of thinking about monetary policy and what how you would answer that.
So I don't know that I could put a precise number figure on how much money should exist. Uh, for the amount of goods and services getting produced in the economy, you need a certain amount of money to facilitate those transactions. So that's of course going to be a lot higher in a large country like the United States compared to, a smaller or third world country. I think a far more important issue to worry about is how fast that quantity of money changes. When you have a pretty stable supply of money, if you have enough, I'm not sure the precise amount matters, partly because the amount of money that you have and what the price level is are very much related questions. If you have less money, you might just have a lower price level. But no matter the quantity, no matter the price level, when you get big changes, that can be an issue.
So I want to ask you more about that in a little bit, but one of the things I wanted to ask you about before that is how we should create money when we do it, or how we think about when we do decide that we need money, how it should be done to either inject uh, capital, or I've heard conversations about quantitative easing. What are those options, and how should we think about that?
So I'm going to kind of split this into a couple of questions. When you think about the central bank, like the Federal Reserve, creating new money, the only thing that the Fed can really do is change the monetary base. What are the bank reserves? How much currency, like physical currency, is circulating? The money supply is going to be affected more by credit markets. We have fractional reserve banking. Banks take deposits. They loan a certain percent of that out. And to get money supply, measures like M2 to increase, you do need the banking system to do that, even after the Fed increases the monetary base. So when I think of how much money or how we should create money, I think, being the free market guy that I am, that the banking system can do this fairly well. That if there is demand for loanable funds, people are going to be trying to get it. That will drive interest rates higher. That can encourage more saving. That could bring interest rates back down. But I think that money creation can be done very well autonomously without too much Fed intervention. I think when the Fed does intervene, there's definitely potential for abuse and some adverse consequences. But I would really prefer to see the money supply just be handled by the market and the banking system.
So when the banking system increases or takes action, you mentioned the credit markets, that has an impact on M2.
Mhm.
Is that does that lead to more debt in the economy by utilizing the credit markets? And if not, how should we think about that and navigate that?
So it absolutely does lead to more debt in the economy, but that may not be a really long-lived issue. So when you have the bank lends money out, the bank can create money, reserve ratio, say 10%. You put $100 in the bank keeps 10, lends out 90 of those. All of a sudden, we have a money supply of $190 before more lending takes place. They have not created any new wealth. Wealth is going to be production of goods and services. Now, is the debt going to get repaid? Banks usually want to check out whether the borrowers can repay the loan. They should. If they're worth their salt, they will. They don't want to lose money on it. So when you have this debt going on, if you're going to repay it, you have to somehow put value into the economy. You got to do something with that. If you're buying a house, you have to go to work, earn money, do something for your employer, make the money and repay it. You borrow money to start a business, there's debt, but if you create value, create goods and services and sell them, that's when you increase economic activity and wealth and repay the debt. So debt is a part of this, but if the banking system is doing its job, it's going to get repaid and you do get economic growth.
So, uh, are there circumstances where the Fed should step in, and what do those circumstances look like where the Fed should actually be the one to create more money?
So the Fed at times has targeted monetary aggregates like M2. They've also targeted interest rates, which are, going to reflect both the supply and demand of loanable funds. And when you hear the Fed talk about setting an interest rate or an interest rate target, what they're committing to do is manipulate the monetary base and hopefully the money supply to affect the interest rate. The Fed doesn't tell banks what interest rate to charge for mortgages or anything else. They don't tell the buyers at auctions of treasury bills what to bid. Now they can and often do have historically fairly well controlled that by what they're doing. How well that works in the future is an open question with levels of debt. I personally am very skeptical that the Fed should be involved in money creation. The Fed also does function as a lender of last resort. If there's going to be a serious financial crisis, there may be some good reason for that. However, there's naturally a moral hazard issue that maybe banks will be a little more reckless if there's a lender of last resort there. So I take a much less interventionist view than many people do. I'm very skeptical that Fed efforts to create money are ever a general good idea if you're just trying to manipulate the economy.
So, in this moment that we're in the United States, we have this massive national debt. Is the national debt an indicator of any kind of need for um, a larger money supply, or is it? Uh, I guess that's one question, but then also thinking about the challenge of paying it down. Is it the way I've always thought about it is there are four options. There's taxing, cutting, growing, and printing. And I wonder if you think those are, if that's a comprehensive list of options, and if we can actually pay down the debt without getting to the printing option.
Well, I'm not sure that all of those are. I'm not sure that printing is even a solution to that. To pay down the debt, I don't think there's really a lot of potential to pay down the debt just with economic growth. And we can talk about growing our way out of the debt, but the fact of the matter is government revenues do grow with economic growth, but so do the expenses. So if you have a structural problem, if the government's spending more money than it's bringing in, I don't think economic growth is a solution until you solve the political problem. I think there's a need for some combination of tax increases and spending cuts. I think that's where the issue comes from. If you print money, and maybe that's an oversimplification to print it, if the Fed increases the monetary base, tries to bring down Treasury interest rates, that's going to lead toward money creation. That's essentially what was tried during the massive deficits for COVID stimulus checks. And the result of that was some inflation. I've published some research on that, trying to pinpoint about how much inflation, almost to the amount of what we saw, came from that. So printing is going to cause inflation, and that is not going to solve the debt either because government expenses, when prices throughout the economy go up, so does the amount the government is spending on. Medicare reimbursements, Social Security checks, those are really big drivers of the debt. Those go up at least as fast as inflation. So printing, growth, I don't sense those as being solutions, but tax increases and definitely spending cuts that are going to be painful, I think are the only real solution.
So, just in thinking about the solution, um, there's there's like solving the deficit and then there's solving the debt, right? So the deficit, I imagine would be an easier problem to solve where you figure out, at least in the current year or in the next few years, how to get to a place where you have more coming in than being spent, but the national debt seems like a almost insurmountable number. Uh, do you view it that way, or do you think it's conceivable that we could pay it down in the time period of like a home mortgage or something like that?
So I don't think it could be paid down in the time period of a home mortgage. When I look at, the debt, it's more than 100% of GDP right now. And if you have, say, an income of $100,000 and you buy a $400,000 house, all of a sudden you're in debt to the tune of 4 times your income. And people do that, and they do repay it. But the way they do that is by spending less money than they bring in. They don't keep increasing the debt. So if you can rein in the deficit issue and run some surpluses to start retiring the debt, I think it's just a matter of time before the debt does come down. And if the deficit can be handled, I don't think that the levels of debt are insurmountable or problematic. There are some countries that have much worse debt to GDP ratios than the United States. And if we can, get a handle on the deficit right now, I don't view it as insurmountable. But if we can't solve that political problem of the deficit, it's gonna get ugly. That's just the numbers don't bode well if you can't rein it in early.
So, with regard to the kind of the size of the debt, is it conceivable that we could get to a place where we still have national debt, but we um, manage it well? We don't run deficits anymore, and it's just a debt that we're more comfortable with than the current scale. Is that more likely than, say, paying it off in, I don't know, 50 years?
Uh, well, I don't think paying it off in 50 years is going to be the smartest idea if you don't, because way to look at you have to run surpluses to finally retire the debt. It means you do have to bring in more money than you're spending. Anytime the government does that, it's essentially pulling more value out of the economy than it's putting in. Running the deficit, we were spending more money than was being generated. So there is going to be some adverse effect on economic growth if you're going to run those surpluses. So I don't know how fast we want to do it. Rolling over the debt, as long as it's not going up, and doing it maybe even over longer than 50 years, could possibly be about the best idea. I'm not sure what time frame I would recommend, but if we can run even just modest surpluses, fairly small surpluses, for the foreseeable future, I think that's the single best thing we could do.
So I want to go back to the you mentioned inflation associated with the COVID stimulus,
Hmm.
and also that there would be inflation if we were to ever uh, you were talking about how fast we if we were to ever print money, it would be a matter of how fast and how much, and that would be like an indicator of how much inflation would be caused. Can you talk a little bit more about that and um, the causes of inflation and how we should think about inflation in this moment and in times like when like you mentioned COVID-19?
Hmm. So inflation, there are a number of schools of thought on this one. There's Milton Friedman, who said that inflation is always and everywhere a monetary phenomenon, that it happens when the money supply is increased. I think there's a lot of truth to that. Recently, John Cochrane has promulgated the fiscal theory of the deficit and inflation, that you get accumulated deficits, meaning there's going to be a need to repay stuff later. That changes expectations and leads to inflation. I find myself kind of somewhere in between. I think what really causes inflation is when the government runs a large deficit and the Fed simultaneously increases the monetary base, tries to cut interest rates to keep interest rates low while the government's borrowing money. Because if you don't have the Fed's action, the government wants to borrow a few $1 trillion, that's going to push interest rates higher. We call that crowding out because there's more demand for the loanable funds. And that will temper money creation. You won't have too much money chasing too few goods. So I think a deficit alone doesn't cause inflation. When you have the Fed trying to keep interest rates low, buy more treasury bills, hopefully get more money into the economy, If the banking system doesn't actually create more money, you might not get inflation. We did not see inflation during the quantitative easing. The Fed was buying up these assets. Bank reserves just shot through the roof, but the banks weren't really lending it out. So there again, no inflation. But when you have the Fed's action and the big deficit together, that's what caused the inflation.
So this may be a more foundational question, but what is inflation? Is it just when prices go up, or is it when like can there be inflation in one industry and not another? Is it only when aggregate prices go up? How do we define inflation for all these periods of time?
So inflation is defined as a rise in the price level. It wouldn't just be, price of one good goes up, price of another goes down. It's a general increase in the price level. Prices throughout most, maybe not all, but most of the economy are going up. Uh, how you want to measure that's an open question. Anytime you're going to take millions or billions of different goods and services, each with their own prices, and condense this down into just one number, you are losing information. That's what averages do. That's what summary statistics are, is a condensing of information. So different prices do inflate at different rates. There's not going to be one rate that uniformly hits everything. Some things will inflate more than others. Maybe a few things go down while others go up. So we can talk about measurement to no end, but inflation is an increase in the price level.
So in the case of COVID-19 or the moment that we're in right now where there's conversations about tariffs, those are really more or at least the either the stimulus or the tax or whatever it is, those are more about specific industries and how those like we need to look at a more granular way than the aggregate way that you were talking about. Is that
Mhm.
an accurate way to think about it?
Yes. So when you have the money supply going up, you're getting monetary inflation, as we sometimes call it, inflation caused by an increase in the money supply. If you get tariffs on imports and we're really reliant on those imports, you will get some prices going up. That's not monetary inflation. Maybe industries kind of reorient themselves. Maybe the prices come down eventually. I don't think that tariffs are generally a good idea most of the time. Most economists don't. I'm certainly one who doesn't really like tariffs, but that's not going to be monetary inflation, and it won't really persist, meaning the price level might go up because of tariffs, but it shouldn't persistently go up year after year, absent some other cause.
Yeah. I'm also curious about what individuals and small businesses can do while we're dealing with uncertainty in the market and thinking about the notion of prices going up for various reasons. Um, I remember concepts related to substitutes
Mhm.
and just thinking about like small businesses that are both taking prices and also setting prices at times is how should we think about like the individual's role and how they could operate in like an uncertain economic environment?
So it's because it's uncertain, you can't really predict the future. So I'm not going to say there's one specific strategy. Uh, if when it comes to substitutes, goods that have lots of substitutes are less prone to inflation because if people can switch to something else, they will. If you are wealthy enough that you're buying a lot of luxury goods, you're in better shape because you can go toward lower cost alternatives and not have your pocketbook hit too hard, even if your tastes and preferences aren't always satisfied. If you don't have a whole lot of money, there's not really an easy solution if the necessities are going up in price because they're necessities. If you are a business, most resources you could be trying to buy have multiple suppliers, sometimes in different countries. And supply chains can be fairly resilient. It's good to have people who know how to handle and manage supply chains. I mean, people get degrees in this. But being able to source things from multiple suppliers, if prices go up for one, it's like having more substitutes. So I say for businesses, keep a handle on your supply chains.
Yeah. Well, so when for example a supply chain is disrupted, if those prices go up because of that supply chain disruption, what you were saying before, that wouldn't be considered, at least not considered monetary inflation. It would be prices going up, but to your point, it would have it would be potentially temporary. Is that right? Or
Potentially, it depends on how easy and how long it lasts. It depends on how easy it is to, kind of restructure the industry. I mean, if there's a huge tariff on Chinese imports, well, there are plenty of other people in countries other than China who could start producing something and maybe accounting for the tariff, do it at a lower cost than China, and production kind of moves there. We reorient where we're getting stuff from. That is doable, and that's why it's not monetary inflation. As monetary inflation kind of hits everybody because it's about how much money is in the economy. Now, restructuring your supply chain, where the factories are, that's not an overnight solution. Depending on the industry, that could take years.
so, just sticking with international trade for a second, the notion of tariffs impacting the consumer has kind of been talked about a lot. I'm wondering if there are any conversations about also like the macroeconomic or the kind of relational impact between countries. What do you think about international trade as a mechanism for diplomacy, and what do you think about kind of the macroeconomics of international trade right now?
Well, you can use the threat of tariff barriers and other, trade restrictions as, muscle in diplomacy, but you got to know who your opponent is. Are they going to respond in some way that could be even more harmful? What's your bargaining power? It's a real game theory question, and it may or may not work. So it's risky. It can create enemies. It can invite retaliation, and if you're okay with that, I suppose it could work. I mean, there are many diplomatic tools that people could use, but you have to be cautious with it. We had the in the Great Depression, like the Smoot-Hawley tariff. We threw tariff barriers on all kinds of products coming into the country, and many other countries reciprocated, and the result was just a collapse in global trade. Certainly didn't bring in more revenue for the government, didn't make consumers' lives easier, and didn't build goodwill globally. So I think, yeah, maybe you can use it to try to get countries to do what you want, but no guarantees that it works. And I don't really think you should do that on countries that you try to stay on friendly terms with. Doing that to allies can be hard to live with. They're harder to live without. So I don't like the idea of tariffs on countries that we consider friendly toward us.
Yeah. So I want to also talk about GDP for a minute. The narrative that I've heard about GDP is that generally as GDP goes up, at least over the past 100 years, so has quality of life. Um, do you see that as a relationship or correlation that will continue into the future, or is it possible that we could see quality of life to continue to go up around in the United States and around the world without GDP going up as quickly?
So I think there is going to be a correlation between GDP increases and quality of life. I have not seen an example of any country's standard of living going up without the GDP increasing. So how fast that's going to go in the future compared to the past, I don't know. But I don't think there's a route to higher living standards without higher GDP. I think it is important to pay attention to how things are distributed. I mean, you can get a large GDP from government purchases and getting more and better lethal weapons for the military. And I suppose there's a need for some of that. There definitely is a need for some of that, but that's not really raising living standards. So I think increases in GDP, when they're because of market activity, innovation, I think you will get increased standard of living. And there is a need for some inequality. I think there are both good and bad causes of inequality. And if you don't have too much of a problem with that, I think there can be ongoing standard of living increases, but you do need the GDP to go up.
Hmm. So I'd love to just get a sense from you about what you think is changing right now and what the future might look like in a macroeconomic sense. What do you think about where we're at right now and the possible futures moving forward in terms of things like inflation or the things that we've talked about, inflation, the debt, and monetary policy. What do you see in maybe a three, maybe a 10-year time horizon?
To me, it doesn't really look all that promising if we stay on the current trajectory. I don't know how soon a fiscal crisis is on the table, but it's just a matter of time before that happens if the deficit's not reined in. Now, I think it's eminently possible to reduce the deficit, start running some surpluses. And if that can be done within the next couple of years, I think the future looks fairly bright. I mean, that's of course contingent on geopolitical circumstances and not having a huge period of conflict. And who knows about that? The future's unpredictable. But I think there's a lot of potential for very good, bright future for the country's economy. But it's going to come down to, can the deficits be reined in? As far as monetary policy is concerned, if the deficits are under control and you don't have too much intervention from the Fed, which I don't think has all that great of a track record of working, I think there again, the future looks pretty bright.
Just maybe one more follow-up question. What do you think about the kind of the advent of new technology and its ability to disrupt some of these macroeconomic dynamics? So thinking both in its ability to improve quality of life, but then also things like AI and automation, um, displacing jobs and disrupting people's lives, and those two, those maybe contradicting dynamics where one is, improving quality of life and one is, making a lot of people worse off. How do you think about that moving into the future?
Well, people have been worried about job losses because of technology for centuries. Go back to the Luddites during the Industrial Revolution. As far as I can tell, people like to be employed. They need to be employed. I want to be employed. But job destruction is really what you need for ongoing economic growth because we're doing more with less. I mean, if you want everyone to be employed, we could get rid of, modern farm equipment and have everybody work harvesting food out in the fields. And nobody would be out of a job, and that's not really a desirable way to live. I like having all that modern farm equipment. So yeah, there's going to be some isolated instances of pain and job loss, maybe a little more than we would like. But over time, new industries have developed. People have found their way into other fields of work. And there's a painful adjusting process, but it does tend to happen when you let the market do its thing.
Hmm. Well, you've given the audience a lot to think about, and I really appreciate you taking the time to talk. Thank you so much for
Mhm.
sharing insights, and I hope we can continue the conversation down the road.
Yeah, I'd be glad to.